Why most farmers and SMEs are rejected for loans in Africa. Across Africa, millions of hardworking farmers and small business owners walk into banks with hope and walk out with disappointment.
My loan was rejected. The bank said I don't qualify. They only fund the big people.
But here's the truth. Most rejections are not about bad ideas. They're about missing structure, weak records, and unmanaged risk. It's painful, but fixable. And that's what this video will show you. The number one reason most farmers and SMEs are rejected is poor record keeping. Banks do not lend to effort, they lend to evidence. And evidence lives in your records. If you can't show how much you produce, how much you sell, or how your costs change over time, the bank cannot assess your ability to repay. Think about it. You may know your farm by heart, but the banker does not. They don't visit your land. They look at numbers, because numbers tell your story when you're not in the room. Even simple handwritten records, tracking yields, sales, expenses, can make a huge difference. A farmer who keeps records builds credibility. An SME that tracks transactions builds trust. And trust opens doors. The second big problem is cash flow, or rather, the lack of understanding of it. Many farmers and small business owners mix personal money with business money. They can't show when money comes in or goes out. So even if their business is profitable, the cash flow looks unstable. Banks don't just check income, they check timing. They ask, can this business pay its loan when the installment is due? A farmer who earns once a year after harvest but applies for a monthly repayment loan, that's a mismatch. An SME that gets bulk payments every few months but spends daily without planning, that's risky. Cash flow management is not accounting, it's survival. When you plan your cash flow, you plan your growth. Then comes climate and risk exposure, one of the most overlooked reasons for rejection. In agriculture, everything depends on weather, water, and energy. If you rely only on rainfall or old equipment, the bank sees risk. In business, risk could mean supply chain disruption, market changes, or power outages. The more unpredictable your environment, the less confident the lender feels. That's why banks now love green or climate-smart projects. Not because it sounds nice, but because they reduce risk. A farmer using drip irrigation or solar energy looks more stable than one relying only on rain. A small business with a backup plan looks more resilient than one that shuts down during blackouts. Risk management is financial language. If you speak it, the bank listens. Many small businesses run on trust alone. No clear roles, no written agreements, no structure. The fourth reason for rejection is poor governance. But banks don't fund friendship, they fund systems. When a business has no registration, no defined ownership, no accountant, and no formal operations, it looks unstable. You may work hard, but from a lender's view, hard work without structure equals risk. Even small changes help. Registering your business, separating business and personal accounts, assigning responsibilities, keeping simple financial statements. Governance is not about size, it's about seriousness. When you show structure, you show discipline. And then there's the big one, collateral. Many believe banks reject them because they lack land or property. But the real issue isn't just what you own, it's how your business manages risk. Collateral helps, yes. But even when you have it, a weak business plan or poor records will still get rejected. Some banks now even reduce collateral requirements for green or well-structured businesses. Why? Because they see you as safer. So instead of saying, I don't have collateral, ask, how can I make my business low risk? That question changes everything. Green finance is not just about the environment. It's a key to unlocking approval. Because green finance focuses on sustainability, efficiency, and risk reduction, it fits perfectly with what banks want. If your farm uses renewable energy, efficient water systems, or climate-smart practices, you're already managing risk. If your SME tracks operations digitally, cuts waste, and plans for resource efficiency, you're already bankable. Green finance tells the bank, I understand risk, and I manage it. That's music to any lender's ears. So think of green finance as your bridge from rejection to approval. Here's how to start improving today. 1. Start keeping records, even simple handwritten ones. 2. Separate business and personal money. 3. Plan your cash flow according to your income cycles. 4. Adopt one climate-smart or efficiency practice. 5. Register and structure your business. 6. Build relationships with local financial institutions early. Change doesn't happen overnight, but consistency wins. Each improvement makes you more credible, and credibility attracts capital. Most rejections are not the end of your journey, they're feedback. Feedback that says, get structured, get stronger, get sustainable. If you're ready to turn rejection into approval, subscribe to AgriGreen Finance Africa today. Learn how to build financial confidence, manage risk, and attract smart funding. Let's grow smart. Let's grow green. Let's grow sustainably.